Although most Americans are in some form of debt, a mortgage, car payments, or credit cards, they generally view debt that it is bad. After all, if you owe someone money, you usually pay back more than you initially borrowed. And most people like to have more money than debt because the more money one has, the more stuff that they can buy. They think this without really realizing that the dollar in their pocket is in fact a debt, and that debt is not only good, but it's actually essential to the creation of more money. To understand debt and money are one and the same, I'll discuss three key points. What the modern dollar actually represents, who controls the flow of that dollar, and how they create that dollar from a debt. Once these are understood, hopefully the perspective of debt can be changed and you'll think of debt as not necessarily a bad thing, but a needed thing. Before the use of paper money that's common today, the early settlers traded amongst one another with gold and commodities such as wheat, sugar, and spices. This barter method, although efficient, didn't quite give the colonists financial freedom from England that they desired. Not only that, the young nation was still a mesh of immigrants from different countries that had different currencies. So after the independence from England, the U.S. created the first Bank of the United States and solved this problem between states whose currencies were different from one another. The banknotes and coinage issued from the banks were backed by the gold in their vaults. This is defined as representative currency because the note was redeemable for its equal value in gold. It wasn't until the Civil War where a shortage of gold caused the United States to rethink the use of representative notes. This gold shortage led the United States to print $150 million of banknotes known as greenbacks, whose value was no longer backed by the gold in the vault, but decreed by law. This law-decreed dollar is known as fiat currency, and is the currency in use today. At first, the Americans strongly opposed this idea, calling it unconstitutional. But according to Westlaw.com, the case of Knox versus Lee was key to this issue. In this case, the United States court ruled that the creation and use of this fiat money was under the governmental powers and thus constitutional. Now that the history of the US dollar has been brought to light, I'll discuss who controls the flow and supply of that dollar. In response to the Civil War, the National Currency Act of 1863 not only provided funding, but also established a new banking system using this fiat currency. This legislation additionally encouraged the United States to join state banks together in an attempt to create a national banking system backed by the U.S. Treasury. This system worked relatively well for about 30 years. It was not until, according to MarketThoughts.com, that the panic of 1907, where the New York Stock Exchange fell almost 50%, that caused the United States to enact the Federal Reserve Act in 1913. This aimed to provide a national currency that was insured and controlled by a central institution. This institution is the Federal Reserve, more commonly known as the Fed. The Fed consists of 12 regional banks throughout the country, with the main office located in Washington, D.C. All 7 members of the board are president-appointed and must serve a 14-year term. Now that there is a basic understanding of who controls the U.S. dollar, I'll now discuss how the Federal Reserve creates new money from debt. If the Fed needs to create more money, it doesn't just simply print more. This would severely devalue the money in circulation because only about 12% of the United States money is in the physical form of paper and coin, rather than the 88% that's credits and loans. This is found on TradingEconomics.com. And in order to create more money while avoiding this problem, the Fed uses a system called fractional reserve banking. This process starts with the Federal Reserve creating a loan to a commercial bank, who must keep a required fraction of the loan in its vaults. This amount is known as the reserve requirement and is proportionate to the amount of transactions that the receiving bank currently holds. Then this bank can further lend out money it received from the Fed to other banks, charging interest, while paying back on the original loan it has with the central bank. These banks can also loan money to the people while keeping the reserve requirements in the vault and charge interest on these newly created loans. These borrowers go and spend the money they received, further stimulating growth while paying the debt back to the lender. This process creating more distributive wealth that is originally derived from a loan by the Fed. And since loans are a promise to pay the lender plus interest, this newly created wealth is only possible because of the debt created by the central bank. Thus, the money in our pockets come from, and in essence, are a debt to this central bank. Now that I've discussed the modern dollar, the institution who controls that dollar, as well as the method in use to create new money, hopefully the stigma of debt has been lifted and one can view debt in a new way. That debt is not necessarily a bad thing and is actually essential to the creation of new wealth that provides our economy with growth.